And welcome to another edition of the Nerdy Agent Podcast. I'm your host, Luke Pettersen, with my brothers and fellow nerds, AJ and Josh. Today, we are going to recap the Fed meeting from last week, what was said afterwards, and we'll get into everything you need to know as an agent, what it means for the market. But first, the Would You Rather of the week, which I think Josh threw on here. Would you rather have a secret passageway or a room with a 360-degree view? Now, the first question is, where does the secret
That's
passageway
what I'm wondering
go?
too. It sounds creepy.
The secret passageway leads to a utility room, but the 360-degree view is of, pure concrete.
The secret passageway leads to the utility room?
But it's pure concrete for your view.
Yep.
Josh says.
It's bad on both
I
sides.
don't want either one of those.
I mean,
I'm kidding. I don't know where the secret passageway.
We actually just toured a home with a secret passageway. Mm-hmm. Luke, me and you did. From a house to a church.
oh yeah.
It was a cool passageway.
Yeah.
But it was boarded up and looked a little creepy.
It looked very creepy.
In the catacombs, there was a scroll, and the scroll led you to another place
with a 360-degree view.
of the ocean.
I choose 360-degree view, no question. I mean, unless the passageway leads to some cave with a hot spring or something.
I'm thinking my secret passageway sends me wherever I'm feeling like going at that moment.
Well, it's not a
And
magical
I'm taking the
passageway.
secret passageway. It's a secret. How do you know it's not magical?
I have a client who really wanted to have some sort of secret passageway in their house, and they bought a house in the basement they didn't like, so they refinished the whole basement, and they put a bookshelf that he could push, and it would open up into the utility room.
I almost did that, and it was this is kind of silly because all my books are going to fall off when I open this door.
I don't know. His books didn't fall, but I don't know. Yeah, it was
Heavy books.
It was kind of cool. I mean, it's pretty cool looking, but yeah, to get to the utility room, you have to push the door open. That's a bookshelf.
Yeah, he can have fun in his utility room changing his furnace filter, and I will have fun in Florence, Italy when I open my secret passageway. To start, let's get into what actually matters here. To start, and I know this is a little bit basic, so stick with us, people, but for the people who don't know, remind the listeners what the Federal Reserve is and why they matter.
It's a non-government entity, kind of. They say it's non-government, so we'll just say that's what it is here. That basically assesses the economy and then issues monetary policy for the entire country. So they basically control how the banks are loaning money to each other, how they're loaning money out from Fed facilities. They purchase loans from time to time. They've done that for several years. They have a balance sheet. They're kind of like an agnostic third party to the entire economy, trying to keep things in check.
And when we talk about the Fed, so we say the Fed, that means the Federal Reserve. When we talk about a Fed meeting, what does that mean?
So on a monthly basis, they meet, they discuss kind of different monetary policy strategies that they want to consider employing. And as these meetings go, there's Fed chairs in different cities around the country, some of the key cities, and they report out kind of how things are doing within their own markets. And then they work together to kind of come to a consensus as to whether or not they need to make any monetary policy adjustments. And then they actually do a share out, similar like how public companies report earnings. They go through an actually process of reporting out, here's what we decided in our meeting and here's what's going to come. And it's important to be following this. And if you've listened to this podcast for a while, you hear us talk about the Fed all the time because right now interest rates are all the rage in terms of what's going on in our market, in the real estate market. And so these changes in these discussions and the way they signal in these meetings when they report this news out does drastically impact interest rates. And so it's really important to be following along with it to understand what's likely to happen to interest rates. And they control the Fed funds rate, which once again, we've talked about this in too much detail, so we don't need to go into it too much. If you're listening for the first time, go back to some of the prior episodes that talk about the Fed, and you can really get up to date on kind of some of the stuff that we're talking about there.
So last week, and I think when this podcast comes out, it may be like a week and a half, 2 weeks ago, the Fed met for their June meeting. So we're going to run through kind of what they said, why that matters, what it might mean. So to start, how did they assess the current state of the economy?
I mean, the inflation has come down a bunch, which is to be expected. When you make money more expensive, people spend less of it, whether that's on groceries, housing, cars, whatever. You've seen it starting to impact certain segments of the market. But from a macro basis, it's down under 5% now on a year over year number, and it peaked right around I think it was 8.9, 9.1, something like that in the United States. So it's come down below expectations in a lot of these months. The Fed's projecting that they're going to get it under 4% in 2023. For reference, their long-term goal is 2%. That being said, I still think there's something to talk about in the basis of you're looking at a year-over-year number. So when the year-over-year number was 9 before and now it's 5, it doesn't mean that it's been 5 forever. So you're basically just resetting the amount of inflation we're working off of a much higher number. When it runs 4.5 times what they want it to, and then they even get it back down to 2, you're still seeing higher prices permeate through the economy because it had that amount of time to move prices upward.
Yeah, Target, we talked about a lot when I worked there about what's called a 2-year stack. So there's always the year-over-year change, but what is the 2-year impact? And as you're thinking about, that was something we used a lot when there were just weird things that happened that made things look really strange. So if you're up 5%, or if you're up 15%, then you're up 1%, you're still up, roughly 16% in 2 years. So that's more meaningful in some cases when numbers go haywire than just looking at that 1-year number. And so I think that's kind of what the Fed's saying is, yes, we expected it to come down because it went so nuts, and it will continue to come down as we start going over those year-over-year, 8-9% numbers. I did think it was interesting. The economy is in kind of a weird state right now because the Fed has really put a lot of pressure on it to slow down, but the stock market's up like 15% this year. The job market continues to be really strong. So we added 340,000 jobs last month, exceeding the projections of 190,000. And, inflation is kind of slowing to a level that people seem to feel more comfortable with. So in a lot of cases, the market seems really pretty good now compared to where it was. And people are still borrowing, even though, our interest rates in our market are like 7% right now in real estate. So it's kind of interesting that the Fed is looking at this going, well, some of the things we're doing have caused some problems with the banks, but at the same time, the market's pretty solid. But we're not going to get to 2% inflation unless we continue to do this, even though we're pausing for this month. And so it's going to be interesting to see what they do going forward because they kind of highlighted that this is working and we're getting back to a better spot. But if 2% is our long-term goal, we're not there yet. So they did signal some future behavior that honestly I have some concern about, even though inflation did come in below expectations for this month.
So you're kind of already starting to touch on it now, but what did they say about rate increases right now and moving forward into the future? And for those, again, just to make sure we understand, this is the overnight lending rate. When we say rate increases, this is what they have impact on. They're not saying we're raising the 30-year mortgage or not raising that. It's the overnight lending rate.
And it's always within a 1/4 point range. So it's 5 to 5.25%, I believe, right now, after the raise they had before. Now, this month, they said, we're going to leave it the same and kind of see what happens.
Which is what everyone thought would happen.
Yeah, it's exactly what everybody thought would happen. Now, they did signal, and Josh has a quote on here, but basically saying everybody on the committee thinks that we're going to need some further increases this year to bring inflation down to 2% over time. So they estimated that the Fed funds rate would go up to 5.6 on an average. So I'm guessing 5.5 to 5.75 on that range, which was projected at 5.1% in March. So to Josh's point, the economy's doing better than they expected, especially the jobs market, wages, all these sorts of things. Even real estate moving the way that it has. Shelter prices are contributing the large majority to that inflation number being higher than they want it to be. And so they're like, well, what do? We can't break everything all at once. So we're going to leave it unchanged now, see what happens over the next month, 2 months or whatever. But they did signal they're probably likely to increase that Fed funds rate even yet in 2023.
Do you think that's, and this is kind of a shot in the dark, do you think that sometimes, because for those who, again, when we haven't touched on this really, but what they say matters a lot to what the markets do. Not even necessarily if they raise the rate, don't raise the rate, lower the rate. What they say makes a big difference on how people act on the secondary market, because what they do causes people to act a certain way. That's what tends to affect indirectly the 30-year. Do you think that they intentionally will meet together and say, hey, we're going to leave the rate the same right now, but we should tell everybody that we're planning to raise it so they don't get too aggressive with things and they stay kind of conservative. And then maybe when we get there, we don't need to.
It's kind of like making an offer on a house just by calling somebody and being like, we'll pay $600,000. And then they go tell their seller and you're like, we will take
Here's
that. And then
550.
you're like, how about 575?
Yeah, well,
Yeah.
it's funny you ask. I mean, obviously we're not in the room, so we don't know exactly, and I don't want to get
Assume.
conspiratorial or assume of what they're doing. But it's been a pretty consistent theme where they release a report that says like we're not going to change this or we're going to do whatever, and then the stock market tends to go up, and then Powell gets up and talks, and he gets kind of conservative with his speaking points that are. The report tends to be like, here's what's going on. Things are actually pretty good. And he gets up and he's like, there's a lot of work to be done. And we might need to do this in the future. We might need to do that. And every single time the market goes up and then the market comes back down the second he starts talking. And so I think to your point, there may be some strategic component to that where, the less you can, if especially because the market's been so just bullish in terms of where it's going, I think the more you can kind of tamper enthusiasm, the better they can do in terms of not having people just overreact on the positive sense. Because they did do a good job, I think, in this one of continuing to just kind of level set, keep everything about the same, not cause panic in the markets, but not cause positive chaos in the markets or bad behavior on that side.
A lot of what we've talked about has been what we need to see, at least from an interest rate perspective, is some stability, right? Like we went from 3 to 7.5. Like we need it to be 6.5 for a year. Like we need it to not change too much. And so that's why I was curious, like what they do is maybe trying to make it so, everybody stays a little bit conservative. Because I think we can all agree. I mean, and we'll talk about it, but if rates went to 5 tomorrow, it'd be horrible for the real estate market probably. It would be not good. It would be chaos.
Just trigger some chaos.
It'd trigger chaos.
Well, I think that rates moving quickly any direction. So we saw that happen in 2020, right? They're like, we're cutting the overnight rate to 0 to 0.25. And the rates went down. I mean, the best I heard was 2.5 on a 30-year fixed. When it happens fast, typically the buyers, especially if it's moving downward, the buyers are going to be the ones that jump into the market very, very quickly. So I wasn't going to buy a house. The rate went from 4 to 2.5. And it seems like I have to. Like I talk to my parents, they say I have to buy a house. Mm-hmm. They're talking to an agent. They're getting pre-approved in 2 days. Now a seller, it's a huge life move. And a lot of sellers might have kids or jobs to think about or
stuff they have to clean up.
Move and clean up. And so they say, well, God dang, if I can get my forever house now rather than in 3 years, and I don't know if I'm going to have 2.5 forever, I'm going to look into this, right? Well, then they're meeting with an agent. They're prepping their house. They're doing this. They're trying to figure out how they're going to finance this whole transaction. They're scheduling moving. They're making sure they're looking in an area where they can buy and still get to work on time. And there's just so much more to think about when you're selling and buying, or even when you're just selling, that they might take a month, 2 months, 3 months to jump into the game. And so April 2020 would be a great example where everyone was like, all right, let's put our masks on and go see some houses. And there was not nearly enough homes available for the rates that we were getting. And so it was just gangbusters busy for buyers and super, super competitive. Now, when the rates shot up in October, November, December, then buyers dropped off. The homes that were already on the market are just sitting around waiting to sell. The decision making from a seller perspective just takes a little bit longer. So if the rates, like you said, are stable and even moving downward, because that's what we're
slowly
all kind of anticipating, right? Slowly moving downward. If they're moving a quarter point a quarter from 7 today and they get to 6 within 1 year, that probably wouldn't change the marketplace dynamic too much. But you're right. If they all of a sudden got up and said, oh, we're cutting from 5 to 3 on the overnight rate, and the rate went down to 4% again, 4.5%, whatever, it would just get more competitive, and the sellers would frantically be scrambling to get their house on the market so they could buy a new house. But it's going to take them a month, 2 months, 3 months to do that. So there's this lagging period with sellers that I think really impacts the competitiveness.
So not to get too off topic there.
Sorry.
No, that's good. I like that. So how did their decision affect kind of what they just said this last time, not doing anything to the overnight rate? How's that affect interest rates? How did that change in the last
They've
week?
sat pretty steady. So we're still in the 6.9 and 6.95 range, which is still, at least recent history, quite high. It has impacted some folks and, has continued to have an impact on just the level of activity that we're seeing in the marketplace. So pendings will continue to be, I think, challenged by this. And so we're just going to, at least at this point, it seems like we're in for a little bit of a longer ride at these levels than what we had previously anticipated. I know at the beginning of the year, everyone I think I heard it more so from the lending side of things, but there was all this like, well, rates will come back down to the mid fives by the end of the year, by the middle of the year. What we're hearing and seeing is not suggesting there's any expectation that that's going to be happening in the near future. So if the Fed funds rate continues to rise up and gets in the 5.6 range, you're going to see interest rates in the 6, 9, 7, maybe go over 7. It's just kind of what we should anticipate is the future.
Well, and I think you saw the muted response to Luke's point, like, because he got up and said, I might raise the rates more. And then it was like, oh,
we're not going to see them decrease now.
The investor demand was going to go up, but if they're going to raise the rates, now they're going, like my bid and ask prices are getting spread out again on that secondary market. So I think that certainly has made an impact on them staying kind of pat.
Yeah, and I wonder how much this has to do with what's happened in the banking sector too, with the impact the Fed has had on the banking sector, specifically like SVB and some of the banks that have fallen since then, who invest a lot of their capital in these bonds. As they jump around a lot, it tends to cause a lot of friction and problems within the banking industry. So to your question earlier, Luke, maybe he had some of that in mind, was saying, hey, we might raise the rates in the future so the bond market doesn't invert and go crazy and the banks find themselves in a bad spot as well in the future.
Do you guys have any closing words about the meeting last week, or is that, I think we touched on everything that I had here?
No, that's really good. I mean, I think it seems like the market's kind of doing what it's going to do. It's not getting worse or better, at least here in the Twin Cities. We're kind of see it just continue. And I think if rates sort of sit in the high 6 range, that's probably to be expected. Now, I do think, again, seasonality has an impact too. So there's just so many micro factors that influence the overall market here. And, at some point in the summer, typically, I just talked to Uriah this morning, who told me that July is one of the worst 3 months for files turned in always. Mm-hmm. Every single year, it's one of the slowest ones because people go do July 4th. They might do another trip.
They release.
Yep. People are they're just a lot less active in that month. And then in August, everyone's kind of scrambling to get something done before the fall. And then it opens back up for a couple months and then it slows down again. So it's always hard to say, as we go through, what are pending sales going to do? What's the market going to do? How active is the demand going to be? And is it because of what interest rates are doing, or is it seasonal, or is it something entirely different?
Yeah, I think there's 2 key takeaways that I would leave people with, because obviously we're talking to real estate agents who are talking to clients. On the client side, we've said this for a long time, but I think there was some really poor communication that was happening with clients earlier as the rates were rising, which was like, date the rate, buy the house, or marry the house, date the rate, right? Which was like, basically like, rates are going to go down in the future, so just buy your house now and just deal with it, and then you can refi in the future, right? Which was, I thought, really irresponsible that people were saying, because we didn't know where rates were going. And I think this has continued to signal that this expectation that rates are just going to plummet quickly is not looking as likely as it was previously, or like looking as likely as everyone's unbridled optimism was suggesting. So I just think, as a real estate agent, be thoughtful about how you're communicating with your clients about interest rates. We've always said to our clients, if you're comfortable with buying the house at the monthly payment with today's interest rate, you at least know that's going to be locked in for 30 years. So if you think that's a good acquisition for you and you're comfortable with this monthly payment, move forward assuming that's going to be your monthly payment for the next 30 years. If something happens where rates come down and you're able to refi, that should be seen as a net positive in the future. But don't go into purchasing a home with the expectation that you're going to be able to get a lower payment in the future and stretch yourself thin on the front end on that sense. Because I think that's irresponsible on our end to be communicating to our clients. The second thing is, as a real estate agent, it's been a hard year for you, right? So this marketplace with these rising rates has created buyer activity that has been slower and seller activity has been slower. And so we're down 30% in pendings. A lot of people are struggling and they're trying to figure out how to be successful in this market, or assuming it's going to end right away. If you're sitting on the sidelines trying to figure out what to do, or you're saying, well, at least the rates will come down and then I'll be doing well again in the near future, I wouldn't have that attitude. You have to get out and be active right away, whether that's finding a way to have new lead sources coming in, or figuring out a way to just get out there and meet with people or do opens and all the stuff we've been talking about, how you have success in a down market. You need to buckle up for maybe a little longer than you had anticipated, because right now there's no signs that this market is going to change drastically in the next 6 months. So if you're just saying, well, rates will go to 5.5, then I'll be fine again, I wouldn't expect that. So think about what you need to do to be successful and try to, get out there and push, because those who push will have success on the back end of this down market. but there's no timeline right now for when that down market's going to end.
6 months ago, we told the agents on our team, we said, you're going to have to work 2, 3, 4 times harder this year to get the same amount of transactions as last year. And that might not be fun right now, but in 3 years, 4 years, when however many percentage of real estate agents fall out of the market because they just didn't last through this, there's going to be a lot of pie left for the people who stick through. If you are in the Twin Cities market and you feel like Josh had just said, you're feeling like you're struggling, it's not going very well, and I don't mean to plug our team too much. We don't do it very often, but we are doing pretty well in this market. Our sales are up. There's a lot of different things that we're doing to still be successful. There's a lot of knowledge and value that we can add that we can maybe help you with. We'd love to sit down and chat about if it might be the right fit. So always feel free to reach out. Always DM us. We want to help. We want to be a resource.
And even if you don't want to join the team but just want to chat with us,
sure,
we're always
more
happy
than
to
happy.
chat. Heck yeah.
We have this podcast. We try and tell you everything we know. And that's all we have this week for the Nerdy Agent Podcast. And as always, remember, be better.
Goodbye.